All right, some definitions to know. I've talked about a few of them already. So mortgage servicer is the person, the company, the entity that you send your mortgage payments to, like Bank of America as a bank also does mortgage servicing. Ocwen is not a bank, they're a loan servicer, Ocwen Loan Servicing. They're the largest non-bank mortgage servicer. Right behind them is Mr. Cooper, which used to be called NationStar. So they don't typically own the loan. They service it on behalf of somebody else, like Fannie Mae or Freddie Mac or mortgage-backed securities or something like that. The investor is who owns the loan. So that's like Fannie Mae or Freddie Mac. They buy loans on the secondary market, but you never get a bill from Fannie Mae to send them your payment. You'll get it from Bank of America or Ocwen or Chase or whoever. So the owner of the loan is typically where the rules and the guidelines for how the short sale process is going to go come from. It's not the servicer. They're following somebody else's rules. Bank of New York Mellon as trustee, if you look at a foreclosure file and you see something like that, that loan was pooled with a whole bunch of other loans and sold on the stock market as mortgage-backed securities. The trustee is technically like the owner of that pool of loans. Then you have mortgage insurance company, PMI being private mortgage insurance, so you have a conventional loan with private mortgage insurance. If you're doing a short sale on that, not only does the investor have to approve, but the mortgage insurance company might have to approve. Depends on the agreements that the servicer or the investor may have. The servicer or the investor might have what's called delegated authority, where they can approve the short sale without mortgage insurance's direct approval. Private mortgage insurance, if they have to approve, can be a deal killer in certain circumstances. If the homeowner moved and bought another home, you're not getting approved for a short sale by your mortgage insurance company. And if you do, they're going to want a whole bunch of money from you, promissory note or cash at closing or something like that. They're not letting you off the hook. FHA is another type of mortgage insurance. FHA is by far the most difficult short sale that you will have to do. And there are the largest percentage of loans that we work on are FHA short sales. They take longer than any other type of short sale. There's a building worth of red tape that you have to go through. The servicers do a horrible job at navigating through those guidelines. They almost never get it right, and we have to go and escalate to HUD and have HUD step in and properly explain their rules to the servicer. But for these different types, you have Fannie Mae, Freddie Mac, FHA, VA at the bottom here, Guaranteed VA, and then you have USDA also. Those are all different types of short sales. A short sale is not a short sale. Every single one of them is a unique situation depending on the homeowner's circumstances and the particular set of rules that you have to go through in order to get them qualified. So why do the banks do short sales?
Can I just, so basically that means that if you did a short sale 6 months ago and you're like, oh, I just did a short sale, it was easy, no big deal. And you're like, oh, I'm going to do another one, this should be easy again. Most likely, you may not have that same situation because they are all different, and depending on which servicer, what investor, you could have a whole different, ball of wax there.
Yeah. So for the banks, they don't do short sales to help people. They do short sales to help themselves. Even FHA, their guidelines, more people get denied for short sales on FHA loans than if they had a conventional loan, they'd be approved. But because they have FHA, they got denied for certain circumstances, and we'll go over some of that stuff. But aside from FHA, where some of their guidelines make no financial sense whatsoever, the other types of loans, it's basically they're just looking to lose as little money as possible. Once they've reviewed the homeowner's financials and determined that they have a financial hardship, they recognize that if we don't do anything, we're going to have to foreclose. If we foreclose, it costs us money. If that property is already worth less than the amount that they owe us, not only are we going to lose money when we sell it as an REO, but the longer this goes on, the more money we're going to lose. So for them, it's mitigating their loss. If it looks like they'll lose less money by doing a short sale than the alternative of foreclosing and selling it as a bank-owned property, then they'll approve of a short sale. Usually where you run into an issue with that particular logic is if they think it's worth a heck of a lot more than it really is. We'll get into how they do their valuation and stuff. Short sales typically lose less money than the option of foreclosing, so they're avoiding foreclosure, resolving the delinquency on the account sooner, getting the money in their pocket. They don't have to manage the property. So they're avoiding having to go through REO. But it's a financial decision for the bank. It's just all based on their guidelines. And the way the banks are set up is they don't typically have somebody outside of a small bank, like say a credit union. Even when you get to regional banks like Webster, the people that you're dealing with don't have the authority to approve or not approve of a short sale or approve of exceptions. They have to go up to like manager or something. The larger the institution gets, that ladder is so high they don't even try climbing it. They just deny. This file doesn't fit in the box, you're denied. So a big challenge of what we have to do is try to make the homeowner's circumstances fit into the box to the best that we can. And not everybody, a lot of times, fits into the box. And if you do a poor job of explaining the hardship to the bank, not trying to make it fit in the box or focus on the information that fits in the box, you can really easily get denied. And you're like, well, I sent you everything. I mean, they have no income. How could they possibly not have a hardship? But depending on how you sent it and what information was sent to the bank and how sloppily they reviewed it, if it doesn't fit in the box, they've got no skin in the game, especially a mortgage servicer. It's not their money that's being lost. I get this question all the time. Don't they want to resolve this as quickly as possible? Aren't they just losing more and more money? Whoever owns the loan is losing more and more money. The mortgage servicer gets paid every month to service that loan. The longer they service that loan, the more money they make. So the longer they have that loan, the more money they will make on that loan. So resolving delinquencies faster is not necessarily in their best interest.